It's time to talk about arbitrage funds. And don't worry if this doesn't immediately make sense to you. We're going to discuss this in as much detail as is required for you to understand the concept completely. Join me to talk about arbitrage funds is Harsh Roongta, founder of Fee-Only Investment Advisers. Thank you so much, Harsh, for taking the time. I think it's important to start first with what is arbitrage, because this is a concept that is not new. In fact, if anything, it's very old. It's something that has existed even before formal markets have existed. It's a concept that is fairly easy to understand. How would you describe it?
Oh, absolutely. Arbitrage is like, the same product if you buy in one market and sell it in another. Okay, so that you're not really taking a risk on the price. You're just, as they say, arbitraging between price differentials. And arbitragers are crucial because, they ensure that markets act in unison, that price differences do not grow beyond what is rational and relevant. Uh, and to sort of understand this, yeah, if you look at an example, you know, uh, like today when I was doing the work on this show, uh, HUL at that moment was quoting at roughly about 2052 if I was to purchase it on that day. At the same time, it was possible for me to sell this with delivery date 31st March at 2059. Now, that's a difference of 7 rupees. Now, assume that I simultaneously entered into both the contracts. I bought HUL at 2052 today, and I entered into a contract simultaneously to sell HUL on 31st March 2022 at 2059, which means I have locked in a profit of 7 rupees. I would have to pay 2052 rupees today. I will get 2059 rupees on March 31st. This is now irrespective of what happens to the HUL price between today and 31st March. The profit of 7 rupees is locked in. This 7 rupees, if you see as a percentage of the investment, which is 2052, is 0.34%. And the time gap between today and 31st March is 15 days. If you annualize this 0.34%, that becomes roughly about 8.27%. So that becomes a fixed return as far if I'm able to enter into this transaction at these rates. This is irrespective of what happens to the underlying HUL share price during this period between 22nd March and 31st March. Now think of a fund. So although the underlying is an equity share of HUL, my profit is fixed. It's like getting a fixed income from an underlying security, which is listed equity share. And I think of a fund that does these kind of arbitrages. And that this is the simplest form of arbitrage. There are many other forms, but this is the simplest. Buy in the cash market, sell in the futures market. And
Absolutely.
typically the difference in the cash and the futures constitute the interest payment. So, typically the difference will be interest.
Yeah.
So I think this would best describe what kind of things an arbitrage fund does.
Absolutely. And in fact, you've explained this in an example from the formal market very well. In fact, another one, just to elucidate this point further, is to say that I go to a bazaar and I buy 3 kgs of wheat for, say, 100 rupees, and I go maybe a kilometer away from that market, and in another bazaar that same 3 kgs of wheat is worth 110 rupees. I sell it in that market for 110 rupees. That 10 rupees that I make is the arbitrage. effectively that is the same thing. I mean, what I'm trying to get at is that there are various types of arbitrage. You've described one type of arbitrage. Is it that you will always make a profit in an arbitrage fund, or are there risks of losing capital?
So, I mean, arbitrages can, as you have yourself said, of various kinds. When you do a perfect arbitrage, which means it's completely hedged, right? You have bought it today and you have sold it in the future, then there is no question of their making a loss. See, the only risk that a pure arbitrage fund would run, okay, are really operational risks. So if the constitution of the fund is such that it allows only pure arbitrages, then really speaking, you cannot run a loss except because of operational losses, or if the fund sort of exceeds its constitution, which is not allowed. I'm talking of in the context of a mutual arbitrage mutual fund.
Trying to get at, which then brings us to the next point, which is, why would you use an arbitrage fund? What role does it play? So you said that it gives you fixed income like returns, but it can invest in equity products. Is that really the biggest positive when you're talking about arbitrage funds?
Yeah, so I think the biggest advantage that the arbitrage fund of the kind that we just spoke about, and those are the kind that exist really, at least in India, the benefit is that these are classified as equity funds, and that's because what they do is invest in equity, buy cash and sell in the future. Therefore, there is a tax advantage. Any short-term gain on the sale of these funds is taxed at 15% instead of a normal tax rate. So think of those who pay taxes at 30%. So there is a straight saving in the tax that they pay. Even the period to consider it as long-term is 1 year instead of the normal 3 years. And long-term capital gains is at 10% instead of the normal 20% on other kinds of funds with indexation. So that 20% probably works out to about 15, 16, 17%, or lower or higher depending on what the indexation has been. So these advantages are therefore quite, so I mean, any of these funds, any investment for that matter, you always evaluate on this risk, return, liquidity framework. So, the risk of an arbitrage fund is typically, I mean, not regulatorily, I would not say is the similar to a liquid fund, but I would say it would be akin to a liquid fund, obviously not as good as a liquid fund, but similarish to a liquid fund. Okay. The second, if you look at the return, then because of the tax advantage that it enjoys, the gross return would more or less be similar to a liquid fund. But the post-tax return, because of the tax advantage that it enjoys, would obviously be higher than a liquid fund because of the lower tax. And that is material to people who pay tax at high rates. On the third parameter, liquidity, it's not as liquid as a liquid fund. In fact, most arbitrage funds do a payout only after 3 days. So if you redeem your arbitrage fund today, it takes 3 days for the money to sort of come to you. So if you plan to, so you hold money in a fixed income fund for most people with moderate to, moderate to high risk profiles. The reason you would hold funds in a liquid or an income fund is that you would need this money in the short term, in the next year or 2 years. Now, if you need that money in 6 months, then maybe the arbitrage fund is not the right option, simply because any benefit that you get, you would need to do an exercise. But as a rule of the thumb, any benefit that you get in return, post-tax return, because of the beneficial tax treatment is negated by this delay in getting your money back. But beyond 6 months and say up to a year or 2 years, which is the period for which typically you would hold a fixed income fund, the arbitrage fund works out simply because of the tax advantage.
Let's talk about some of the goals that you would use this to achieve. Now, traditionally, if you were to talk about the liquid fund, you said that you can compare this in a sense to liquid funds because you're using this to park money for a short period of time. And you said beyond 6 months. Now, would you say, for example, that you have a certain amount of money? Say you have a wedding that is planned in 8 to 10 months, and you know that you're going to need, say, about 10 lakhs for that wedding, for whatever expenses that you will incur. You have that money right now. You don't want to let it sit idle in your bank account. Would you say that this is a kind of a goal that you can use an arbitrage fund for? What are the various goals that you could use it for?
So this example you gave is perfect. If just imagine that you know a wedding will take place sometime next year, right? The date has not yet been fixed, right? So it could range from 6 months to 18 months, right? Ideal for an arbitrage fund, but you would need the money. You cannot have value going up and down because this is the money you will need. So you can't really take an equity risk on, no matter how high your risk profile is. With this kind of a requirement, you cannot take risk of equity. So that's one. Uh, we use it frequently for what we call tapering. Just like you should get into a fund for the long term on a systematic basis, you should also get out on a systematic basis. We call that tapering. So as you're coming near to the goal, let's say you have saved up for your child's education, okay, and now her education requirement is 2 years away, and you have been saving up for the last 8 years or investing for the last 8 years in equity. I think it's about time you start tapering. And an arbitrage fund is ideal for this kind of a tapering because it extends for some period. So except maybe for the last 4 or 5 installments, it's otherwise ideal for tapering.
Let's also get into the choice of arbitrage funds. Are there a certain number of parameters that you need to bear in mind when you're choosing, or is one fund as good as the other?
So, when you're choosing fixed income fund, then I would put arbitrage funds in the category of fixed income funds, although in the category it is defined as a hybrid fund, but I would put it in the category of a fixed income fund. In this three parameter framework, risk, return, liquidity, I would not give too much importance to return. That's not your objective function. When you're just safety, risk is the big function, okay, that you would give a lot of importance to. Return, even if somebody has, if somebody is a big outlier, has outscored some one arbitrage fund has outscored all other arbitrage funds by a margin, it would make me very suspicious, right? Because in a fixed income fund, it's very difficult to be a outlier either which ways, unless there is a credit loss. It's very difficult to be an outlier either positively or negatively. What we therefore do, and that's not really so, if we are using it for tapering, we use the arbitrage fund of the fund in which the equity investment has happened, because a systematic transfer works best within a fund house. Okay. But if we are forced to choose, we typically would see, we would work with say 5 or 6 or 7 fund houses, and those that have large arbitrage books, which means that they are able to take advantage of the opportunities, etc. See, costs are extremely relevant here, and therefore those funds that are large are able to amortize those costs better, and they have some expertise in looking at slightly offbeat opportunities as well. So that's how we would say choose funds. I think there is a whole list of funds which I have given, which probably is visible on the screens right now.
It is indeed. And in fact, that draws this conversation to a close. It's been an insightful one. Thank you so much. I've certainly learned something new, and I hope my viewers have as well. Thank you so much as always, Harsh.
Thank you, Alex.